Welcome back from the break. I think we all were all very excited when looking at the example Nigeria. So we nearly forgot to make a break. But I think from time to time it's good to recreate a little bit, drink a coffee, and then start again. And that's exactly what we're doing now. We're starting again with the example Nigeria. We were looking at calculating any goodwill, and we saw that we have that also goodwill will be affected by foreign currency translations because we will calculate at the transaction date, of course, when we get the net assets of the subsidiary. We will determine what is the goodwill at acquisition, and then from time to time, we will retranslate the goodwill into the presentation currency. And doing that, well, we will end up in a difference, which is the group exchange difference. That is a foreign currency difference that relates to the parent and also to the non-controlling interests. So we split that, and then we can go to determine what are the non-controlling interests at year end. So we will take the NCI at acquisition date, that is translated at the rate of acquisition, of course. And then we will allocate any share of post-acquisition profits and exchange difference to NCI. That will be translated at average rates. So the result will be NCI at the end of the period, but that will be again retranslated with a different rate. So again, we will have foreign exchange differences. Now, when we do so, we see that at acquisition, we had a historical rate of 4. We divided the 30,000 dinars, giving $7,500. Then we have the post-acquisition profits of NCI. We have the group exchange gain on net assets, and we have the group exchange gain on goodwill. So the NCI will get their fair share, and then in the end, they end up being 38,900. So goodwill, of course, is a good full goodwill, and therefore the gain on goodwill will also be allocated to the NCI. If that was a normal goodwill based on proportionate net assets, then we would not show a gain in the foreign exchange rate on goodwill. We would not allocate that to NCI. But in this case, we will. Well, then we go to retained earnings. The parent's share of post-acquisition profit is also considered in retained earnings, and that will be shown in OCI. Sorry, this is the retained earnings plus the parent share of the post-acquisition profit. So that part goes to the retained earnings of the year, because that is considered to be earned, because it's real profit. So that goes to retained earnings of the group. Now, what about the foreign exchange currency reserve? Well, we have to calculate that one also, and we know that this one goes into OCI. So the parent's share of the foreign exchange difference of on net assets is a difference that is related to the fluctuating currency rates. So therefore, the IASB has said, well, it is just a a difference that has materialized on that particular point in time, but it may be higher or even lower in the future. So we don't know whether it is realized. So therefore, we will put that foreign exchange difference into OCI. And also the part that is related to the goodwill also will go to the foreign currency reserve. But nevertheless, it will be shown in OCI, and therefore it relates, of course, to the shareholders, to the majority shareholders, to the parents' shareholders. Okay, so that is also, I think, clear. Or are there any questions? Well, if not, then we go to the translation of assets and liabilities. The simple rule number one said all assets and liabilities are translating using the closing rate. So we will go to the non-current assets plus the fair value adjustment less the additional depreciation. So that is the non-current assets at year end. And we will calculate, retranslate those dinar amounts into dollar using the year-end rate. So that results in 54,500. The current assets, same. Non-current liabilities, same. And the current liabilities are also retranslated at the closing rate. So that's easy. And then we can go to the consolidated statement of financial position. And well, we know that we have to translate all these amounts using the average rate. So that is the fair value adjustment minus depreciation over 10 years. Sorry, we are in the consolidated statement of financial position. So that's the balance sheet, and we have to use the closing rate. So that is clear. So fair value adjustments minus depreciation over 10 years. So we have 1 year now, 10,000 minus 1,000 divided by 2, because obviously that was in the middle of the year. No, 2 is the year-end closing rate, sorry. So that is translated at the closing rate. So we have the non-current assets of Lagos. And so we translated those 100,000 by 2, and we get 50,000. So we have a subtotal of 218 plus 50,000. So don't add the dinars because these are bananas. We want to add apples only. So 218,000 plus 50,000 equal $268,000. And then we take into account that we have a debit of 5,000. So that was 10,000 divided by 2. And the 500 is the 1,000 divided by 2, because we are looking at the balance sheet. And in the balance sheet, we have an ending dollar amount of 272,500 because we use the closing rate of 2. Well, capital consolidation, we will eliminate the investment at parent level and eliminate equity at the subsidiary level. So that's nothing different what we had before. So here is the investment of 100,000 in Lagos. So that's what the parents paid to acquire Lagos. And that investment will not be shown in the consolidated financial statements because we have put all the assets and all the liabilities of that investment into the group accounts. Okay, so non-current assets are just add it and translate it at the closing rate. Ordinary shares, where we just eliminate the equity translated at the closing rates. So we would deduct 25,000, 75,000. And in the end, well, you should only have the ordinary shares of the parent, which is true here. So in the end, we will have retained earnings of 151,400. Well, when we go back to W5, we will find that number. So 151,400 is the retained earnings at the end of the year. So we have calculated it previously. So when we go back to the consolidated statement of the financial statements, then we will see this number here, the retained earnings of the parent. Foreign currency reserve, same thing. That were two elements in W6. So let's go back to W6. That was the parent share of the foreign exchange differences on net assets and on goodwill. So 80% both times, and the resulting dollar figure is 99,200. And we will see this 99,200 coming from W6 in the consolidated financial statement. Same thing for NCI. We calculated that in our fourth working. So we saw 38,900. Well, let's have a look. W4, 38,900. Here we are. So we take that number and put it in the consolidated financial statements as a credit. Okay. So equity is 554,000, including the NCI. And well, non-current liabilities and current liabilities are not a problem. So in the end, we have assets of 644,300 and a liability and equity total of the same amount. So that looks good. All right. So when we have foreign exchange issues in the translation of financial statements, well, we would just I think we would not include this dinar column, but do it on an extra sheet of paper, then come up with these figures over here, and then put those two, Nigeria and the subsidiary, side by side, and then do the total, do the subtotal. I just added those this column for explaining reasons, so that you better understand what I did. So I put them in blue. So please don't add those things together. This is the local financial statement, and that is the equivalent single financial statement number 3 or 4 or whatsoever. That represents the same items, but in a different currency. Okay, so that's the consolidated statement of financial position, a balance sheet. We now could look at the income statement if there are no questions. Okay, then let's have a look at the income statement. But before we look at that, we have to calculate the translation of income and expenses. Well, that step is relatively simple, because we would just translate all income and expenses at the average rate. So that's the foreign exchange rate during the whole year, because that represents the period. So revenue 300,000 by 3 is 100,000. We have operating costs of the subsidiary. we have to add the 1,000 additional depreciation, and then we have the normal operating cost, the finance cost, and the taxes. And the profit for the year is 100,000 minus 1,000 additional depreciation equals 99,000. By 3 is a dollar amount of 33,000. That's straightforward, huh? No big problems, I guess. And then we have the profit for the year, which we have to share to the NCIs. We have that 100,000 minus 1,000 equals 99,000. And the fair share for the NCI is 6,667. So that's their profit share, but they also have to share the additional depreciation, which is 67. So in total, the profit for the year will be 6,600. And the next one is comprehensive income, share of NCI. So we will look at the profit for the year that is on NCI, which is on the W9 working. We just saw that figure 6,600. Well, then plus the share that the group exchange gain on asset was related to the NCIs. We saw that number already, and that is 9,300. And the NCI's share in the group exchange gain on the full goodwill was 77,500. When we 20% of 77,500, and that is 15,500. So all in all, the comprehensive income share for NCI is 31,400. So again, full setup, full goodwill. I already explained that one. Okay, so then we can insert our numbers into the consolidation table for the income statement. And again, I have added this additional line in dinar to make it a little bit clearer, but please make sure that you only add up the black figures. So we have a revenue of the parent and a revenue of the subsidiary. The subtotal is 600. We have operating cost. And here we have, when we look at the subtotal of 450, we have to add the depreciation for the machine for that period. And now I think that is quite astonishing, but maybe it's not, because it's clear we are using different rates. So when we look to the profit and loss statement, we have an additional depreciation of 1,000 for the machine. We would use not the closing rate, which we did for the accumulated depreciation. So for the accumulated depreciation, we use the closing rate because that's the balance sheet figure. And here in the income statement, we use the average rate. And the average rate was not 2. The closing rate was 2. The average rate is 3. So we would divide the same depreciation of 1,000 now by 3, because we are in the income statement. And so the depreciation for the whole year is 333. So the same depreciation will be shown in 2 different amounts, because we translate them according to the simple rules, right? We say closing, when we look at the balance sheet, we take the closing rate, and when we look at the income statement, we look at the average rate, and that is the result. We will have the same depreciation of 1,000, and we find that with 500 in the balance sheet and with 333 in the income statement. And of course, there is a difference, right? And that difference will be captured in the foreign exchange difference that we then split to NCI and the shareholders. All right. So I think that is also clear. So in the end, we will have a profit for the year, which is by 333 lower than the subtotal, because we have that additional depreciation of 333. Well, the other comprehensive income, we look at that revaluation plus and that group exchange gain. So that is what is the difference. All those items that did not go to retained earnings of the shareholders directly, they went into the group exchange gain. So we have to account for that, and that was 124,000. So in total, the group will show a total comprehensive income of $242,000. Full stop. Do you have any questions? Well, then, yeah, that's all. And you know, I'm a control freak, so I just try to control that the dollar amount of 30,000 equals the dinar 99,000. So in the end, we will have that additional depreciation sitting in here. And after that depreciation, the dinar amount is 99,000. Okay. And again, when we look at the profit for the year, it comes from the parent. They had 75,000, and the subsidiary, well, the acquisition of Lagos, well, ended up in a profit of 30,000. So 30,000 is 33,000 minus 333 equals that $108,000 amount. Okay, so that's it. What are my key messages on foreign exchange when it comes to the group level? Well, the transactions, the translations at year end will affect assets and liabilities because they are translated at the closing rate. You know, they are near the balance sheet, and therefore they're nearer to money than everything else. So we will use the closing rate. When it comes to income and expenses, well, those are translated using the average rate because the total period will be regarded. And well, goodwill is an asset and therefore will be translated using the closing rate. And the resulting group exchange difference is then recognized in OCI, whereas the difference that is allocated to NCI goes directly to NCI and not into an OCI portion of NCI. So the group exchange difference on net assets, well, it will be split. The parent share goes to the group foreign currency reserve, which we know is an OCI thing, and the NCI's share is recognized directly in NCI. The group exchange difference on goodwill, when the full goodwill is considered, then it will be split. Parent share goes to group foreign currency reserve, and then NCI's share is recognized in NCI directly. And when there is no full goodwill, that means that the goodwill is only attributable to the parent. Then that means that the NCI at acquisition was valued as a proportion of net assets. And therefore, all the group foreign currency reserves go to the parent, and none is recognized in NCI. Okay, so these are the rules and the key messages for foreign exchange differences when we're looking at a group account level. Now let's look, what have we seen so far? So basically, when looking at foreign currency in a group, we first have to understand that that we have two levels. We first have to look at the individual company level. We have transactions there, and those transactions are translated at a spot rate. So we will have either the rate of the date. So when you are looking up the transaction, the foreign currency rate every day, so you can do that. Or you could also determine an average per week or an average per month that you would rather take then. Sorry. So you would use a transaction rate, and that can be determined freely. There are no requirements, national requirements or international requirements, how to come up with such a translation rate. Of course, if it fluctuates a lot and you don't adjust that rate, you will have an argue with the auditor, who probably will not accept that kind of accounting, but that's on a different page. Now, when it comes to year end, when we look at the individual company level, we translate any monetary balances at the closing rate and retain the historic rates for any non-monetary balances. Unless, of course, it's revalued or impaired, but then we go for the last transaction. Now, a foreign currency exchange difference when in the individual company level just directly goes to profit or loss, because we think that at year end, all the differences are realized and they are earned, and therefore will go to profit or loss. That's an assumption. You can argue about that, but that is the way the rules are set up. So individual level foreign currency exchange differences directly go to profit or loss. Well, when you look at the accounts of the group, then some of the rules are a little bit different. So here the rules are all assets and liabilities and their fair value adjustments are translated at the closing rate, because we not translate transactions, we translate financial statements at year end, and therefore we will use the closing rate. I think that is clear. Then when we look at the income statement of a company, we have to translate all the expenses and the income of that financial statement. So we rather use the average rate, because we think that these expenses relate to a period, and therefore we should use the average rate of that period. Then rule 3 is when we look at goodwill that is in foreign currency, this is an overseas asset, and therefore we will translate that at the closing rate, not with a historical rate. So at the year end, we will translate that one with the closing rate. And well, any group foreign exchange differences, and that is different from the individual company level where we put those differences in directly into profit and loss. When we are on the group level, we will send those foreign exchange differences to OCI because we think that, or the standard setter thinks that those fluctuations are not earned and therefore should be parked in a separate caption of the equity, and that is other comprehensive income or OCI, and it's part of equity, and it will not shown in the profit and loss statement. Okay. Clear, or still questions? Well, if not, the last thing we have to look at before we will finish the course is we have to look at disclosures. And well, although there are a lot disclosures in a group, when you look at the financial statements of Wiener Milk or Daimler, then you will see, and we have done that already, that there are maybe 4 financial statements, like the balance sheet, the income statement, the change in equity, and the cash flow statement. So that's only maybe 4 pages, maybe 5, okay? But then the notes are tons, tons of papers, tons of pages. And well, we have to know that when it comes to the consolidated financial statements of a group, we have to look in IFRS 12, which is about disclosure of interest in other entities. So other entities are subsidiaries, associated companies, joint ventures, joint operations, structured entities, and things like that. So we have to follow IFRS 12 to inform the investors, the users of the financial statements with relevant information about the group accounts. So the IFRS will relate to IFRS 10, which is on consolidation, and to IFRS 11, which is on joint arrangements. So there are no note requirements in those 2 statements. They are all bundled together in this IFRS 12, and therefore you have to look into IFRS 12 to cover all the notes for group financial statements. But as you already know, IFRS has a lot of note requirements, not only for the group, but also for all the other captions that are in the financial statements. So it is very difficult to have a complete picture of what has to be written in the notes at year end. So it's a good idea not to look in the standards, but get the checklists from the Big Four or from your auditor directly. They are available for each reporting year. And I have also put the KPMG's checklist into the e-learning system, so you are able to download that and have a look at it. And remember, they are available on the internet, they are free of charge, and it's a good idea to have these checklists when you have to set up disclosures in the group financial statements. Okay. So I will not go into the details. They change every year anyway. So just take the checklist and then work your way through. All right. So Hock, Hognua, Hogmai. Is that correct? Or if I said it wrong, then please spell it, pronounce it for me. I think, well, you have to learn as long as you live. Still, I have to learn every day, and I really enjoy it. So I think we should live with that motto. And yes, that really concludes the course. What I would like you to do is I would like you to open your screen now, and I will try my very best to make a group photo and then upload that one to the e-learning system. We will then have a small break, and after that we will talk about the exam. Okay? Good. So let's close the yes, and of course